Now, two of Africa's biggest economies, Nigeria and South Africa, this week raised their benchmark interest rates by 50 basis points as both central banks keep rising inflation in sharp focus. For Nigeria's central bank, the optics around the country's macroeconomics suggest that inflation and other macroeconomic parameters are not yet in a very good shape. Now let's view the latest CBN rate increase within its monetary policy environment and the wider economy. My guest on this is Dr. Mahmud Hassan. He's the director in charge of monetary policy at the Central Bank of Nigeria. We thank you so much, sir, for making it tonight from our Abuja studios.
Thank you very much.
It's good to have you. Thank you so much for making the time. Now, we saw 11 members of the 12-member MPC voting in favor of the 50 basis point rate hike on Wednesday. What were the facts behind this decision?
Thank you very much. At the global scene, the headwinds are still there. We saw the advanced economies still tightening, albeit moderately this time around. Inflation in some United States is already taking a downward trend, albeit also moderately. We see the geopolitical tensions still going on. The Russian-Ukraine war is still going on. It's affecting commodity prices and trade. We see the China side and the U.S. turmoil is still going on. We see even commodity prices, crude oil, which is one of our major sources of forex inflows. The prices are going down, including the Bonny Light, which is our crude blend. And at the domestic scene, at the global scene too, global output growth is declining. It's projected to decline to 1.3% in 2023, even though we see a pickup coming up in 2024. But at the domestic scene, inflation is still elevated. We are at 22.22. Output growth, you saw the new numbers for Q1, 2.31, coming from 3.11 in the first quarter of 2022, and then 3.52 at the fourth quarter of 2020. So growth is declining. The first quarter Purchasers Managers Index, the PMI numbers, were also not very favorable in terms of the composite PMI, both for manufacturing, services, industrial output, employment. So we see those numbers not signaling, the sentiments around in the economy, picking up for now. Inflation expectation is also deteriorating, meaning that there are projections that inflation numbers will still go higher. And at the capital markets, you also reel out the numbers now. We saw bearish net profit taking. So the sentiments are still besieged with uncertainties. We see the inflation numbers, even though we say month on month, they are declining, but they are still, headline inflation is still high. Even though core inflation is going down, probably because of a lot of interventions that are going into that space, food inflation is increasing marginally, but impacting on headline inflation substantially. So all those parameters are still existing. The MPC members were unanimous in their decision to focus on on inflation, given that inflation is a major deflator of the output growth. Yes, we are aware that output growth is declining. However, the threshold or the territory where the inflation numbers are now is still not comforting. Emphasis have been on inclusive growth, participatory growth, which means that you need to have a larger number of the population participating in the growth numbers you are seeing. The retail end of the low-income side of the economy should be protected because they are the most vulnerable and they impact more on reducing poverty. So it was important that, yes, we are looking at growth, but inflation numbers must come down. So the decision to tighten was largely tied to taming inflation further. The analysis is that what is going on now is having some positive impact, albeit slowly with some lag or longer lags, but invariably the headwinds are still subsisting, and in some cases elevated, and the need to start reversing the policy or pedaling down that is not just in sight.
Okay, Dr. Mahmud, you're in charge of monetary policy at the Central Bank of Nigeria. Walk me through the monetary policy environment so far from January to date. Where are we at the moment? Well, what journey have we traveled so far since the start of the year as far as monetary policy is concerned for the Nigerian economy and the markets?
Since January, we had an MPC in January, we had in March, and then we have this third one. In all the three MPCs, rates have been hiked differently. We've had so far close to 750 basis point increase in inflation. The analysis that was the emphasis at this MPC was, is the rate hike impacting on the aggregates? Is it commensurate with the optimal output target that we're looking at? The analysis that were done and the counterfactual that was shown to the MPC member from the technical side of the central bank staff was the fact that if we had not moderated inflation, if we have not hiked over the period, which is like May to date, of the 7 or 8 MPC hikes that we had, then inflation numbers do nothing now will have been around 30.48%. So in retrospect, the hiking has curtailed the hike in the increase in inflation by almost 800 basis points, which is something that's showing that yes, this is working, but you need to be looking at the other side of the equation too, so that you don't overheat the economy. But the emphasis that inflation is more impactful on the vulnerable, including investors, is very, very important. The effective negative real effective interest rate gap is still very wide. That is important for domestic savings mobilization. It's also important for our external sector in the sense that the returns on investments or inflows, if it is extremely low, don't forget that the advanced economies, the United States, which is the reserve currency of the world, are hiking rate. So, instruments in those economies are a lot safer compared to the kind of uncertainties we have here. So if you are not able to narrow that gap to at least retain, the inflows that you have in terms of foreign investment, particularly in our capital market, then the fly out of those ones, the capital reversal, will have significant impact on our exchange rate, which is depreciation. The numbers you mentioned now was also showing that even in the INE window, you still see some depreciation going up. What is important is the hike was supposed to tame aggregate demand, because we felt the speed at which demand was growing, basically because of the injections that we have post-COVID, not necessarily because economic activities are picking up, but because of the injections, the stimulus packages, the interventions that we had post-COVID, was not commensurate with the speed at which the supply side was growing. So we are seeing inflation that is now demand pull. So there was a need to tame that. So how do you tame that? Is one, with central bank, using the banking system, is to reduce the speed of growth of new credits, particularly to the private sector. And that was achieved because even in the counterfactuals that we showed, shows that as the rate hike went up from March this year, from January, February this year, we start seeing the rate of new credit growth moderating and as well declining, which is good. That's what we are looking at. The money market rate, the numbers you just gave now, shows that the money market rates, the OBB and the overnight calls, are still in double digit. So if you look at the long run interest rate, that is looking at the equities market now, where's the long end of the market, you see that rates are declining. The capital market, the numbers you gave also shows that the market is bearish, asset prices are going down, profit taking is going on, which means that this hiking policy is having an impact, but it gets to a level where we'll now start looking at the other side of the equation so that we don't overheat the economy. So, from January to date, that has been the dilemma and policy choices.
Dr. Hassan, do you think that, how would you weigh the risks to inflation and price stability in the near to medium term?
We think the point is that we are aware that there's a lag impact period, and it's important that we also have a fair accuracy in terms of that lag period, so that you know when you start taking the foot off the gas. Projections are still that inflation will still remain elevated, albeit in the few months. The reasons behind that are, one, if you look at the food side of the equation, the parameters, impacting on that side of the equation are still persisting. The security challenges are still there. The cost of production around the logistics, around bringing the food items to the urban centers or to where value addition industries and manufacturing will take place, is still high. Diesel, PMS prices are still high. cost of transportation is still high. So those will build up to the cost of food. So food inflation numbers are still expected to be at some high level. Flood cases were some of the things we recorded within this period. We also had issues around seasonality of that food inflation because, planting is going on now. So production within the system is a bit muted until maybe end of August when we start seeing harvesting and we'll see, prices going down. So monetary policy is impacting on inflation, but other structural factors are also impacting on inflation, are also drivers of inflation. So while the monetary policy tool can address the monetary phenomenon, the demand side of the equation, the supply side, which is a bit slower to pick up than the demand side, needs to also be looked at. So we expect those factors to play a role in terms of the inflation numbers we're seeing.
Okay, so let's drill down a little bit further. Let's drill a bit further, Dr. Hassan, into the stability of the financial system due to the general elections earlier in the year, as well as the Naira redesign program. Walk me through this. What's the state of the system right now in terms of liquidity, in terms of availability of the currency, in terms of what, if there are new monetary policy tools that your office and the entire central bank is putting in place moving forward?
In terms of the Naira redesign, we saw the impact of that on the PMI's numbers I told you from January to March. We saw the sentiment, which is a survey of the sentiment of the managers, of the manufacturers, including households and individuals. We saw that playing out in the deterioration in those composite indexes that we saw. However, you know that the Supreme Court and all the issues that came about reversed that process. So old currencies are in circulation. Issue about cash availability at least has been significantly moderated. You can see those currencies everywhere now. The bank is also aware of the new deadline on that, and adequate arrangements have been done so that we learn from the lessons of the implementation of the first run. So looking at that space, currency in circulation has increased significantly because deposit balances have picked up because of those inflows that came in. A lot of that were sterilized so that they don't become a monetary phenomenon impacting on inflation. So we see that sitting within the bank. But in terms of the availability of the currency, I think from your own market survey, you know that that is a problem that is significantly been moderated for now. And that feeding into inflation, we've also seen that has also been significantly curtailed. Feeding into exchange rate and all that, we've seen some stability coming up at the INE window, and other segments of the external sector also reflecting these sentiments around moderations coming into that space. I said the inflation expectation is, kind of deteriorated in the sense that individuals, households, and firms are already building in this expectation that yes, central banks is credible. Central bank has remained focused on inflation, and as the governor of the central bank has said that for as long as inflation is above a particular threshold, we will need to be using those monetary policy tools to address inflation. That means taming inflation. So the trust in that has been sustained over the period, at least over the next 1 year. So we expect that to moderate inflation expectation in terms of improving central bank credibility, and that will also play a role in the total number of headline inflations we see. So going forward, towards the end of the year, we expect, significant impact to be showing out in terms of the inflation numbers. And then also, even though the output level for first quarter of 2023 is to 3.21%, we expect the second to third quarter, I'm talking in terms of the outlook now, second to third quarter to improve better. If you look at the numbers for 2022, you also believe that the base effect will have pulled out of the first quarter. So we expect the numbers to pick up. Planting seasons also impacting in during the second and third quarter. We expect that to also increase food supply, and that will also moderate inflation number towards the end of the year. Globally, inflation numbers are expected to moderate significantly, even for the advanced economies, at least towards their long-run target of 2%, and for the emerging market and developing economies around the single-digit margin.
All right, we thank you for your time, and we really appreciate this discussion with you around the current monetary policy and the macroeconomics environment. Thank you so much, Dr. Mahmud Hassan, Director of Monetary Policy at the Central Bank of Nigeria. Have a great weekend.